What if what you thought you knew to be true about the costs of an index universal life insurance policy were wrong? How fast would you want to know it? There was a piece that came out earlier this week from IULdigest.com, and it talks about index universal life. Is it expenses? And really unveiling the truth behind IUL cost. And that's what we're going to break in today. I'm going to show you that based off of this piece that came out, how IULs can be cheaper than whole life. It's going to set some of these whole lifers nuts. And IUL can be cheaper than mutual funds in your 401k plan and that type of setup as well. This is the stuff the industry does not want you to know. Make sure you like, comment, share, subscribe, and let's dig into this thing. Common myths about IUL cost. So the myth number one that they're going to say is IUL policies are expensive. It's like term insurance. It gets more expensive as you age. But the reality is when you properly structured IULs, they have a decreasing net amount of insurance, meaning that as the cash value increases in the policy and you have a level death benefit, the net amount at risk for the insurance company goes down as the policy account values grow. And a lot of people don't ever talk about that. And then some claim that IULs mimic term insurance costs, but they ignore, as I mentioned, that decreasing corridor of the life insurance value, the net amount at risk for these policies. We break it down with IULs versus mutual funds. So the average mutual fund has an annual expense, or the managed money accounts have an annual expense of around 1%, 1.25, I think is the industry average, but we'll call it approximately 1%. But did you know that a properly structured, a well-structured index universal life can have an average annual expense over the life of the policy between 30 basis points to 50 basis points, substantially lower than a 1% management fee for the life of your managed account or your 401k. Obviously, an index universal life policy will have life insurance as a result. 401ks, mutual funds do not. The terminal illness, the chronic rider, chronic illness, the critical rider, critical illness riders are included in the index universal life policies, not in 401ks. Market risk. So you have downside protection with the IULs, depending on which indexed crediting option you choose. And if you choose any multipliers, which we'll talk about here in a second, can have a negative. But if you don't have any multipliers, you have a floor of 0 and some upside potential. And not to say that the performance is supposed to mirror a 401k, because it's not. This is a conversation based off of cost and expense. 401ks, obviously, mutual funds, managed money accounts, obviously have a much higher upside potential, but they also have a much higher exposure to downside risk as well. Inside the 401k, the qualified plan, you've got the required minimum distribution that has to come out at a certain age. That is not inside of an IUL. There's no RMD requirement. You can take out money through the index universal life insurance policy via loans to access your 401k or your qualified plan money. It's a 10% penalty plus tax if you try to access that prior to age 59 and a half. I did a couple videos and you can look at those here. I'll put one video here and I'll put the next video here about how qualified plans can be a tax trap that no one talks about. Would you rather be taxed on the seeds or would you rather be taxed on the harvest? But in an IUL plan, we have complete tax-free distributions that come out of the design. So this is the example that the IUL Digest article used, and I'll put a link to that IUL Digest article here on the page. But here's the example. You have a 50-year-old male putting in $12,000 a year for 20 years, and the author used Midlands or North American's Builder Plus 4 and structured it with a return of premium design. And so the total cost to year 40 inside of that policy was $135,000. And the account value in year 40 was 1.8 million. That's an average cost ratio of 53 basis points, 0.53%. The total year 40 cost in this design was 58 basis points. And the lowest average cost was 40 basis points at year 50, okay? And so here's year one cost. We have an 18%, and this is where people say IULs are expensive. In the initial years, they are expensive. But are you holding this for a short term or are you holding this for a long term? And this is comparable to a long-term investment holding strategy. So you've got, expensive costs in the first 10 years, right? Which obviously that's what people tend to focus on. But when you start to get out to year 20 in this design, your annual expense, your average cost is going to be equivalent to what it is to hold your account in a managed money account for the same period of time for 20 years, right? And as we go to year 30, look at what the average cost is in year 30, 69 basis points. Can't even draw today. 69 basis points, and getting cheaper over time. When you think about your managed money account, that 1% fee is pretty standard. It's going to stay there because that is how your investment advisor, your 401k advisor, that's how they're getting paid, is on that management fee. That's their annuity stream of income. So they're reluctant to bring that fee down unless your account value is substantially higher. But what they don't tell you, and again, bringing this back, is somewhere around the 15th through the 20th year, you're going to have an equivalent cost in this IUL structure that is the same as your all-in cost structure with your mutual fund operating expenses, your managed money fee, everything baked into the 401k. It's going to be the same equivalent cost as to the IUL, but nobody talks about that. In the second example, we're going to use a female, age 40, so 10 years younger, putting in $12,000 a year for 30 years now, same structure, longer pay period. And again, the same cost inside of this is going to be equivalent to your managed money account, your 401k account in the 15th year, plus or minus, well, let's say the 20th year, plus or minus, right? So 1.19% average cost for the life of the policy. That's an average cost for the life of the policy. The beginning years, this is where the policy charges, the setup fees, the expenses, the agent commissions, that's all baked into the early part of the design. It doesn't carry with you as the policy ages, matures, as the policy seasons itself. That's why these are long-term examples, long-term policies. These are not to be designed for a short period of time. And I did a video, you can watch it right here, on 10-minute lesson on life insurance. Tax-deferred growth, tax-free distributions, collateralized opportunities, guaranteed loan provisions, chronic illness, terminal illness, all those benefits that we can get, accelerated death benefit. You don't get any of that inside of your 401k plan. Not to mention in the IUL, you have that downside market protection that we talked about. But the flip side to this, and this is where a lot of play happens in the media, a lot of play happens in chat rooms, is the dangers of a poorly designed IUL. Those are out there, right? Let's be honest. A poorly designed IUL can range between 5% to 10% cost. Those are the expensive ones. The author used the John Hancock IUL with the multiplier that boosts index performance. It has an additional fee, and Hancock's not the only one. There are many other carriers that have this multiplier option where you can buy performance, but in essence does, in a negative year, you have the cost of that multiplier, which gives you a negative return of, say, 7.5% in the worst case scenario, 5%, 3.5%. But your downside floor now is not zero, it's less than that. But Hancock has really good policies as well. You can design a policy with Hancock that is very well designed, that has very low expense cost ratios over the life of the portfolio. So this is not to say Hancock's a bad company. Hancock is a great company. What this is to say is that any bad advisor can design a poor IUL structure with any carrier. It's a matter really, and I did a video on this, is your agent ignorant, lazy, or greedy, or all three? And you can watch that. That's where bad designs come into play, right? It doesn't have to be bad. So why proper designs matter is it allows you to fund the structure up to the IRS allowed maximum, called the minimum non-MEC, minimum death benefit, non-modified endowment contract, maximum premium dollars going in. It helps you avoid unnecessary asset charges. We were able to choose, and we do this a lot. We help clients restructure into carriers with strong cap rates, lower expenses, better opportunities for that interest crediting inside of the policy. Long-term policies can eliminate the 6% premium loads, and policy costs often disappear as the client ages into the contract beyond age 95. Those costs are gone inside of the policy. And so to argue the truth versus the whole life arguments, whole life fans will say IUL costs rise. That's partly true, but it's also misleading. They do rise because the client gets more expensive, but remember that net amount at risk shrinks as the cash value grows. And as I already previously mentioned, by age 95, 99% of the death benefit is covered by the account value anyway. So there's little to no fees inside of the plan at that time. And if you still have a managed money account, you're still paying that 1% fee. And the IUL can outperform whole life in both death benefit and cash value. And we can do any side-by-side comparison. If you don't believe me, we can do any side-by-side comparison to show you how a properly structured IUL can outperform a properly structured whole life plan. By the way, you can improperly structure a whole life plan as well. So that's not to say that they've got the market on proper designs. I've seen many poorly designed whole life structures. And so remember the key benefits to an IUL: low cost when it's properly designed over a long term, right? We're talking a 15+ year window to get to that lower cost. Don't do this if you're trying to do a short-term play. Tax advantage growth and access to the cash via policy loans. Chronic, critical, terminal illness riders come included in the design. You have a 0% floor, which gives you no exposure to downside market risk inside of the interest crediting options. Flexible access to the cash, understanding the design to avoid the penalties, and it outperforms whole life and many other retirement accounts. You can check those videos out. So some final thoughts for you. IUL is not inherently expensive, but it must be designed properly. Cost efficiency improves every year as time goes by. The IUL provides you insurance, plus a tax strategy, plus a wealth building tool. And don't judge all IULs by those poorly designed policies that most people talk about. It's like going to a restaurant. Most people don't give you a positive review when you go to a restaurant. They only give you the negative reviews. Same thing. Most of our happy clients and most of the happy clients that own IULs, they're not out there on the internet trying to show how good things are. It's only when they have a bad design do people go and get on their horn to try to put the negative press out there. So be careful what you read. There's always two sides of the story. So call to action. I want to see how max funded IUL could work for you. Click in the description section. There's an opportunity to schedule a 30-minute meeting with me. Subscribe to this channel for more content that'll bust the myths. There's a lot of deep content already in the channel. Make sure you like, comment, share, and subscribe, and check me out on all of the social media channels. And remember, I got this from the IUL cost article from IULdigest.com.